Welcome to video 3 in a 4-video series, which walks you through the Bull Strangle strategy and will conclude with the details of what is included in the newsletter for subscribers. So in this video, we're going to go through risk optimization. Now, in the second video, we talked a lot about the strategy, and the strategy introduced several concepts that are actually going to be explained in more detail in this video. So it's kind of a chicken or the egg. It's hard to figure out exactly where to start. But what I chose to do was to describe the strategy first, and now I'm going to describe the risk optimization and the risk rules that align with that. As I mentioned, this video is about risk optimization. Now, if you go, just to review kind of the first two videos, in video 1, we really spent our time going through stock options and describing exactly how stock options work. I think the key piece of information out of this is that we are sellers of premium, and that is a very important concept that you really have to get comfortable with before you're going to have any success with this strategy. The second video really went through all the different components of the strategy, and the biggest and most important part of that is the stock picking. And if you recall, I went through some of the recent results, which I think are very, very exciting. And I do expect to continue to beat the S&P, but obviously there's no guarantee of past results are no guarantee of future returns. In this video, we're going to go through the risk rules, and there are 6 of them that are pretty specific that I'm going to lay out for you. Then we're going to get into strategy variations. Now, I've mentioned a couple times that I trade the what I call covered call naked put strategy or Bull Strangle strategy, but I've got 3 additional variations to that, which includes buying a put below the sold put, which turns that into a put credit spread. There's also the variation where you don't sell the put at all, so it's just a covered call. And then the last variation is just to trade the stock alone. And by the way, that's actually doing extremely well. Not as good as the full strategy, but it's a close second. And then the last piece is the market environment. Clearly, this strategy works best in a bull market or a trending market. So this market environment section helps to identify when we're not in a positive market, in which case, of course, we're going to reduce our exposure levels. Okay, so we're going to go through the risk optimization rules in detail in the next several slides here. But if you'll recall in the intro, I talked about kind of the chicken or the egg type scenario that we're in. If I describe the strategy first, I'm kind of backing into the risk optimization rules. And if I describe the risk optimization rules, it's hard to put that in context without understanding the strategy. So I chose to do the strategy first. Now you're going to see the rationale behind the various elements of the strategy that pertain to risk. So proper capital deployment per trade is essential to protect your portfolio from large drawdowns and to keep you in the game long term. Drawdowns are an inevitable part of any investment strategy. Anybody who says they've got a strategy that works all the time is lying to you, or they're just foolish, right? Every strategy has some periods of drawdowns, and you must manage your capital appropriately so that the drawdowns don't blow you up. So on this page and in the next several, here's a simple but powerful risk management framework that uses both capital at risk and portfolio exposure limits. And the first one that we're going to go through is a portfolio level exposure limit. And the rule is that we're only going to have 75% of our capital invested at any given point in time. So the example is pretty simple, right? $100,000 investment capital, our max exposure is 75% of that. And then we are going to reduce it during what I'm calling yellow market environments and red market environments, which I'll go through those in more detail, okay? But the key thing to remember here is that if you're fully invested and you have a bad cycle, you would then need to reduce the next cycle, right? So that's why we want to keep a little cash in reserve, and we'll go through that in more detail. The second one is a trade level exposure limit. Now, the rule is that I want max capital allocation per trade to be somewhere between 5% and 10% of the portfolio. Now, if you recall, I did show that for a very small account, we had to go over the 10% level. And I know that some of the subscribers are going to be starting with less capital than even that. The key thing is to keep the exposure on any individual trade as low as possible. And you can see the example here on a $100,000 account. The max per trade would be $5,000, which is the 5% level, and so on. The third is to use different expiration dates. Now, I've covered this a couple times already. I want to have a weekly option expiration cycle where every Friday a different group of stocks is going to be, or options is going to be expiring. So I want to deploy 25% of my capital, and of course that's at that 75% rate on any given Monday, and I'm just going to keep that cycle moving. Number 4 is diversify across sectors. I can't stress this enough, but we want to be in as many of the 11 different sectors as we can be. The rule is limit exposure to any sector to less than 20% of the trades. And the obvious example here would be if I have 20 open trades, my maximum trades for any given sector would be 4. Now, ETFs tend to expand the number of sectors from 11 to actually several more. And I've talked about how, Bitcoin, maybe a China ETF, a volatility ETF. These are ETFs that don't have a strong correlation to any given market and actually expands the number of sectors that you can be in. Number 5 is to diversify across implied volatility. The rule, choose stocks with different implied volatility. And you can see in the example there, and I've used it a couple times, you want to kind of have the full range of implied volatility on the stocks that you are choosing. And then the same thing applies for diversifying across stock prices. The rule, choose trades with different stock prices, right? Again, going across the spectrum, it's going to be different for everybody based off of your investment level, but you don't want to just load up on a bunch of $10 stocks, if you can go up to $30 and $50 as an example. Now, I'll be going through each of these decision or risk rules in more detail in the following sections. Okay, risk rule 1 is portfolio level exposure limits. And the rule is to limit total exposure to 75% of investment capital. So the reasoning behind this is, number 1, it does cushion against volatility. Markets are inherently volatile, and even the best strategies and strongest companies can experience sharp pullbacks due to earnings, misses, economic data, geopolitical events, or sector rotations. Now, as we've talked about, we've taken the earnings out of it. Cash available acts as a shock absorber, preventing you from being forced to sell positions at a loss during downturns. Second is emotional discipline. When your account is fully invested and a drawdown hits, fear and stress can lead to poor decision making, like panic selling at the worst time. Having cash on hand reduces that pressure and helps you stick to your strategy. Next, dry powder opportunity. Drawdowns often create buying opportunities. If you lose money during one or more of the option cycles, you will be forced to invest less than your targeted level for the next cycle. Stocks or ETFs you wanted at a lower price now become more attractive. With cash ready, you're positioned to take advantage of these discounts instead of watching them recover without you. The next is just risk management. Allocating a portion of the portfolio to cash is a direct way to limit risk exposure. It effectively reduces portfolio beta and smooths out performance, especially for swing traders or active traders. This helps manage the account's overall volatility. And then lastly, it will avoid forced liquidations. In leveraged accounts or margin-based strategies, a drawdown without available cash can trigger margin calls or forced liquidation of positions at a loss. Keeping cash acts as a buffer against this risk. Now, I do want to make a comment about margin. I do not use margin in my personal strategy at all. And in fact, when I'm trading, I'm closely watching what is called kind of a cash available without margin impact is the number that I'm watching. You may decide to trade on margin. I think it's a bad practice personally, but I know a lot of people do it, so I'm not going to tell you can't, of course. But I choose not to. So in summary, keeping cash in your account is not about missing out, it's about staying in the game. Drawdowns are inevitable, but cash helps you weather them. Respond rationally and capitalize on future upside with confidence and clarity. Risk rule 2 is trade level exposure limit. The rule is max capital allocation per trade should be between 5 and 10% of portfolio. The rationale behind this is number one, it protects against major losses. Even the most promising setup can fail due to an unforeseen event. If one goes wrong and you're risked too much, you can cause significant damage to your portfolio. Limiting your exposure to about 5%, even a total loss on that trade, only results in a manageable drawdown. Second, it does help maintain portfolio balance. Overweighting one trade or position skews your portfolio and reduces diversification. Diversification helps smooth returns and reduce volatility by spreading risk across uncorrelated assets or trades. The 5% rule keeps the portfolio well balanced. Third is it reduces emotional stress. Large positions amplify both fear and greed. It is a single trade dominates your account. Small moves can cause big equity swings, leading to emotional decisions like panic selling or doubling down. With the approximate 5% exposure, losses are tolerable, which promotes clearer thinking and more consistent decision making. Fourth, it does increase long-term survivability. Markets are uncertain, and a key to long-term success is staying in the game. If you're overexposed and take a big hit, recovering becomes much harder. For example, losing 50% requires a 100% gain to get back to even. A 5% hit, however, is recoverable with a single good trade. And then lastly, it does allow for multiple opportunities. With smaller investment or individual exposure, you can have more trades working at once without overlapping. That gives you more chances to benefit from different market conditions, setups, or sectors, which boosts overall return potential while still managing risk. One of the things that I put in the newsletter each week is a breakdown on how the 11 sectors performed during the previous 5 days or the previous week. And it's obvious as you watch that week to week how different sectors are kind of leading and the others are falling. They're clearly being across as many different stocks and as many different sectors has, tons and tons of benefits. So in summary, capping individual trade exposure to about 5% is about controlling downside without capping upside. It limits portfolio damage from any one trade, keeps your mindset steady, and allows your strategy to survive and thrive through the inevitable ups and downs of the market. Risk rule 3 is to use different expirations. of course, with weekly options. The rule is leverage weekly options to spread out exposure. The rationale, number one, is reduce timing risk. Entering all 20 trades at once, or whatever your number is, locks in a single market snapshot. If the market drops right after that, all positions may be underwater simultaneously. By spreading entries over 4 weeks, you average into market conditions, reducing the impact of mistimed entries. The benefit is smooths out market entry risk and reduces drawdown severity. The second rationale is flexibility to adapt. Staggering trades gives you the opportunity to adjust your strikes, expirations, or tickers based off evolving market conditions or volatility levels. If implied volatility rises in week 2, you may choose higher strike prices for better premiums. The benefit here is tactical adjustments improve returns and reduce risk. The third item here is less emotional pressure. Deploying all your capital at once makes performance immediately binary. You're either right or wrong. By scaling in with 5 trades per week, or whatever your number is, you remove emotional attachment from any single batch. Again, the benefit here is encourages disciplined, process-based decision making. The next one is improved cash flow management. Each week you unlock a new group of trades set to expire 4 weeks later. This creates a rolling pipeline of income and frees up capital progressively rather than waiting on all trades to expire at once. The benefit, smoother, more consistent income stream. The fifth is better risk control via position sizing. With staggered entry, you can manage exposure more gradually and react to market signals. For example, you can reduce position size if volatility spikes. This helps avoid being over-leveraged in volatile conditions. So the benefit here is dynamic risk allocation over time. And the last one is performance diversification. With 4 distinct entry dates, your options are exposed to different market conditions. For example, earnings cycles, Fed news, volatility regimes. This reduces correlation between trade outcomes. So the benefit here is greater performance stability and less portfolio-wide correlations. Now, we've talked a lot about earnings dates and the fact that we are avoiding earnings announcements for the particular stock, but you can get caught up in what I'll call a sister stock reporting earnings that does impact your particular stock. Anyway, earnings are a factor even if you are avoiding for the individual stock. The conclusion here is that opening 5 covered call trades per week for 4 weeks gives you superior control, risk dispersion, and adaptability. It's a more conservative and tactical approach that can smooth returns, reduce volatility, and align well with real-world conditions where markets are constantly changing. Risk rules 4, 5, and 6. Diversify across sector, implied volatility, and stock price. As for diversifying across market sectors, the risk rule is limit exposure to any sector to less than 20% of trades. The rationale of this reduces correlation risk. Stocks within the same sector often move together based off of industry news, regulations, and macro forces. By diversifying across sectors, your portfolio is less likely to suffer large drawdowns from sector-specific events. The benefit, smoother overall performance and protection from sector blowups. The next rationale is it spreads exposure to economic cycles. Different sectors perform well in different phases of the economic cycle. And next, sector diversifications help balance cyclical and defensive exposure. So you're not leaning too hard into one market narrative. The benefit, more consistent performance through varying market environments. As for risk rule 5, which is diversifying across implied volatility, the rule is to choose stocks with different implied volatility. This balances premium collection versus risk. High IV stocks or implied volatility offer higher option premiums, but they come with greater risk and potential for whiplash or whipsaws. Low IV stocks are more stable, but offer less premium. A mix of both lets you benefit from rich premiums when available while keeping base level stability from lower volatility names. The benefit, better trade-offs between income generation and capital preservation. Reducing exposure to volatility regime shifts. If you're only in high volatility names and the VIX collapses, your premiums shrink. If you're only in low volatility names and volatility spikes, you're not monetizing the opportunity. Diversification across volatility levels gives you exposure to multiple volatility regimes. Benefit greater resilience to volatility, expansion, or contradiction. And then the last one is diversifying across stock prices, and the rule is choose trades with different stock prices. This spreads liquidity and volatility risk. Low price stocks can be more volatile and less liquid, with wider spreads and faster price swings. Higher priced or large cap stocks typically offer more stability, tighter spreads, and consistent option pricing. Using a variety of stocks prices gives you exposure to different volatility and movement profiles. The benefit blends stability and agility in your positions. Expand strategy choice. Some strategies are capital intensive on high price stocks, while lower price names allow you more contracts and gradual position sizing. By using a large range of prices, you optimize capital deployment and maintain flexibility. And the benefit here is more efficient use of capital across the portfolio. So in conclusion, diversifying across sector, volatility, and stock price gives your portfolio breadth, stability, and adaptability. All right, when we start talking about the different variations, I think that I tried to design this in a way that really simplifies thinking about all the different components of these different variations. Bottom line is you can trade up to 8 different strategies, which accommodates a very wide range of risk profiles. So there's really 4 strategies, but you can also add protective puts to any one of them, which then doubles it to 8. Now, the way I like to think about this is that there's really just 5 different components that are used throughout any of the strategies, right? The first is buying stock in 100 share increments, and then there is selling a call above the strike, there's selling a put below the strike, there's buying a put below the sold put, which turns that naked put into a put credit spread, and then there is buying a SPY, which is a S&P 500 or a QQQ protective put, which kind of protects the broader portfolio, not an individual stock. Now, as you go through this, these components are the same no matter what your strategy is. So, for example, every strategy includes the green block, which is the stock, okay? And then the others become a little bit interchangeable, right? So a covered call naked put would include the green, blue, and yellow blocks, and so on. And you can see how you just add these different components to change the strategy up. So following up on the previous slide, I had mentioned and used the kind of the building blocks up in the top left corner. And in the top middle box, I had this, which is in the middle of this slide, the building blocks that make up the various different scenarios. So And you can see how I've color-coded. I have a profit and loss summary example. Now, I have one of these tables for all open trades, recently closed trades, and then the entire watch list from the previous Friday's expiration. Now, this happens to be the latter, the watch list from the previous Friday's expiration. But note that I treat each building block, if you will, separately, and they build on each other as you go across. So in the green column is just the purchase of the stock, right? So I have the open price, the closed price, and then of course the profit. Now I have used kind of forced in shares, kind of tied to a $10,000 average investment. And of course, you get into some increment issues when you try to do it this way. But so the green box is just pure stock. The blue is just the pure covered call portion of it. The yellow is the sold put, and the red is the purchase put, which then makes up the other side of the put credit spread. Now, what I don't have on here is the bot put on the SPY or the QQQ. That's your protective put. I actually do that a bit now. I'm a little bit more, how I feel about the market versus being very disciplined with it. But anyway, I just wanted to point out that I present the profit and loss data, and you can, if you look at the far right, the profit summary, the covered call naked put would just be adding the stock, the covered call, and the naked put together to get to that profit summary. And to get to the covered call put credit spread, you'd add all four columns together to get to that number. Covered call would just be the green and the blue. And of course, the stock only would just be the green. So it's a pretty simple way of doing it. I want to kind of emphasize that the elements of the building blocks are always the same. And it's just how many of them you're going to use, which determines your strategy. So as we begin to go through the different variations, I'm using the same assumptions. In each scenario, we are buying an $85 stock, we're selling an $87 call for $4.50, and we're selling an $83 put for $4.50. And then I'll show you what that is for the put credit spread, which you would be buying a put below that sold put. But we're using the same numbers in all these different scenarios. Now, I'm doing two things here. One is I'm going to describe to you what the trade construction looks like, and then I'm going to show you the various different scenarios that can happen at expiration. It gets a little bit complicated and a little bit monotonous to go through this in a whole bunch of detail. So I'm going to do my level best to explain it as best I can. And most of it can be covered on this very first slide here, and then I'll just comment on the differences as we go through some of the other variations. So this is what I'm calling the full strategy. This is what I trade in my personal account. It is a covered call naked put, or I'm calling it the Bull Strangle strategy. Now, again, these assumptions, this is actually a pretty aggressive trade in terms of the $9 worth of option premium compared to the $85 stock. There's usually one or two of my five that'll have this much option premium, but I will just tell you right off the bat, this is on the high side when it comes to option premium. Okay, so with all those assumptions, I'm going to start on the left side here and just talk purely about the trade construction. Okay, and this is actually pretty straightforward. We start off by buying 100 shares of stock. Now, at an $85 stock, of course, it's just going to be 100 because 200 would put you up to $17,000 worth of investment capital. So I would be trading 100 shares here. I'm going to sell one call above that strike, and I've already mentioned that that's an $87 call at $4.50, and then I'm going to sell a 83 strike put for $4.50 below. So I always think about it: buy the stock, sell a call above, and the put below. And when I'm checking my order entry, that's kind of what I'm singing in my head, literally, as I'm verifying that I've got it right. Off to the right now, we have this profit and loss diagram. So the break-even point on this trade is $79.50. So we can actually see a drop in price of $5.50 and still have a profit, or at least until we hit the break-even point. Our gains are capped once the stock reaches that $87 level. Now, of course, that's always going to be the case. Anytime you get to the call strike price, that's where your profits max out. And then below, you can see kind of a range of different stock prices and what the profit and loss would be throughout. Now, there are actually, in this case, 4 different scenarios. On the next one, there's 5 different scenarios that can happen. I'll describe it this time and then just kind of show you what's different on the other ones. But scenario 1 is the stock closes at $90. Of course, this is above the strike price, so we're going to max out our profit. And in this case, it's going to be the full $1,100. That's literally the best we can do. So congratulations, we're a winner on this scenario. Scenario 2 is it closes somewhere between where you purchased it and below the strike price. In this case, you're going to still have the stock. The call's going to expire worthless. Of course, the put will as well, because we're way above that. And in this particular scenario, we will have gained a total of $1,000. Okay. The next scenario, scenario 3, let's assume that it closes at $84. So this did back up $1 per share. But again, it is in between the strike prices. So yes, we lose a little bit on the stock, but we're keeping both the call and the put. The premium we received on the call and the put, they expire worthless, and we end up with a profit of $800. The next scenario is if it closes below the put strike. And here I'm looking at dropped all the way down to $78. That's well below the put strike. So we are going to lose $700 on the stock decrease, but the call does expire worthless. The naked put expires in the money, so we are assigned 100 shares at $83. So we bought more, which adds to our loss, of course. So we lose $500 on the assigned stock, but we do keep the premium of $450. So the net loss on all of this is $300. Okay. Now, if you drop down even further, and the reason that I have this 5th scenario in there will become apparent on the very next slide. But in this scenario, of course, we continue to lose money as it drops in price, and our loss goes all the way to $1,300. Now, on the right side, as I mentioned, we have a range of profit and loss based off of different areas. But I also include this table that shows the different scenarios that happen. So in this case, above $87, the stock is called away and we have our max gain. The spread expires worthless. Between $83 and $87, we keep the call premium, and the put expires worthless, and we keep the shares. And then below $83, the call expires, the stock loses, but the puts expire in the money, and we are assigned 100 shares. So those are all the possible outcomes that can occur. Okay, now we're going to do the covered call put credit spread scenario, which the assumptions, again, are all exactly the same, except that we are adding this bought put that's a $75 strike that we are going to buy for $1.70 or $170. Now, the profit and loss, comparing this strategy to the previous strategy, are exactly the same for the first four scenarios, except for the $170 that we spent. So if you just take the previous scenario and you subtract $170 from each of the first four scenarios, you end up with your profit or loss here. The bot put begins to kick in at the strike at $75, and it's here where we start to get some level of downside protection. Now, what makes this scenario a bit unique compared to the other one is that below $75, which is the strike price of the put that we bought, that $75 put covers the $83 put. So in the previous scenario, we were assigned 100 shares of stock and then end up with 200. But in this scenario, because of the put credit spread, we just have the 100 shares remaining. Now at that $70 level, we do have some savings comparing the two different strategies. Whereas in the first scenario, we were down $1,900, but here we are just down $1,570. So you can see how you start to get a level of protection with the bot put. Okay, here is the covered call outcomes and profit diagram. Covered calls are the simplest. Well, the simplest would just be stock only, which I don't even have a diagram for that because it's so straightforward and it's the basis for that all traders do seem to understand. But a covered call, of course, we are buying the 100 shares and then we are selling a call above that. And in this case, as in the other examples, we have an $85 stock and an $87 call that we are selling for $4.50. So as in the other examples, our profits are capped once we achieve $87. Anything above that, we're still getting the same profit of $650. Our break even is $81.50. And of course, as you go down, our losses are not capped. And then you can see at the bottom the variety of outcomes that there are. This slide now summarizes the three scenarios that we just reviewed along with the stock-only P&L diagram. As you can see across the bottom, these are the same tables that I had on each of those. But the thing I want to point out is how these perform in different environments, I guess, or in different outcomes. So the stock-only is absolutely the best option if the stock rises significantly. And of course, this is the case because you're not capping the gains at all. The covered call is your best option if the stock drops significantly. And the reason that this is the best in that scenario is that you don't have that put that is going to cause you additional losses as you drop below the strike of the put. And then the covered call naked put and the covered call with the put credit spread are really the best options for everything in between. Now, it is this everything in between that the vast majority of our trades are going to end up. So, this is why I clearly favor actually the covered call naked put scenario. And that's what I trade consistently. As I said, I do occasionally do the buy a protective put, but for the most part, I'm straight up covered call with naked put. Okay, we're going to finish this section by reviewing protective puts. So a protective put can smooth out performance during market turbulence, but it's very important to understand that this is usually at a cost. Think of this as literally just like buying insurance, right? You don't expect a profit when you buy insurance, right? You insure your car. Ideally, you're never going to use that insurance on your car or on your house. But if your house gets blown over by a tornado, obviously you're going to be very happy that you have the insurance. But, you know, my best example, if I just think through, I own rental properties. I have actually 10 of them right now, and I've had most of those for about 25 years. I've been paying insurance on those houses for that entire period of time, and I've got literally one claim that's of any significance. But that one claim, actually, I drew about $70,000 out for that one time. So think about it, over a 25-year period of time, I was spending money on insurance and not ever getting anything back, just so that one time I could get something back. Now, I haven't updated this since May the 16th, but this was actually a pretty good comparison of a couple different scenarios. So if you think about 2024, this was a very strong market throughout the entire year. Off the top of my head, I think the S&P was up 20% or more. I don't really recall exactly. If you'd have been buying a protective put, and I'll go through the assumptions here in just a minute, you would have lost $6,924 throughout that period of time. And that is I guess that's an 11-month period of time. There would have been just 3 weeks out of those, 45 total weeks, that you would have had any kind of return on that put that you purchased. And your percent profit, even on those weeks, really wasn't all that great. Okay. On the right side is basically all of 2025 through May the 16th. Now, if you'll recall, we had a pretty significant sell-off in April and the first part of May. And so this actually was profitable for those 20 weeks. But if you look at them all together in the totality, I think this is what you could actually expect. This would be for almost a full year and a half. You would have had, let's call that a $7,000 loss and a $4,000 gain. So overall, this would have been $3,000 worth of loss, or $3,000 less profit on whatever strategy you're using. Now, let me go ahead and go through the assumptions. I am looking at, the assumptions are that I'm looking at a SPY put purchased 2% below the current price. We're purchasing it on Monday morning for expiration 4 Fridays later. So it's exact same cycle. If you were going to deploy this or use this tactic, you would do it right alongside all your other trades. It is, I had to kind of do some assumptions. I did calculate in the risk-free rate of return adjusted monthly. I looked at the implied volatility for the market, and I factored that in. And using these assumptions, one put covers a $50,000 portfolio. So if you're going to try to cover, a $200,000 portfolio, which I used in one of the examples previous, you would do this every week. If you were going to just cover a $50,000 portfolio, you would just do it once every 4 weeks, right? And that would get you to the numbers. But I think it's very important to understand that this truly is insurance, and you're typically going to lose money long term. One more point on this is that the cost of the protective put varies significantly with volatility. So if you look on the right side again, the cost of the put was really cheap going through January and February. And if you just think about the fact that we had like 6 or 7 months of just pretty strong market. So the premiums on the puts got to be very, very cheap. But when you look at it, after the turbulence in April and May occurred, we started to see a pretty big spike. So that's one thing that's also a bit of a downside about this strategy, is that when you need it the most is when it costs the most. So, that's just something to be aware of. All right, now we'll do the third and final section of the third video. And this section is all about gauging the market environment. So let's start this section with a market environment overview. The overall market performance plays a significant role in the outcomes of a covered call naked put strategy, as it directly affects both the underlying stock price and the option premium received. Now, here's a summary. In a down market, stock prices fall, which can cause unrealized losses on the long stock position. The option premiums provide a buffer, but it typically isn't enough to fully offset sharp declines, especially in severe downturns. Covered calls outperform holding the stock alone in a decline, but the strategy will lose value overall. The impact: limited downside protection. The strategy helps cushion but does not eliminate the losses. In a flat market, this is where covered calls really do excel. Stocks remain range-bound, so the premium collected from calls becomes consistent income while the underlying stock holds steady. Since the calls may expire worthless, and the puts too, the trader can resell new calls repeatedly, compounding returns. Now, I have talked about the fact that we do want to avoid earnings, and you're not going to typically trade the same stock more than 2 cycles, but I do want to be aware of that. And in a strong market, the stock price may rise above the strike price, resulting in the call being exercised. This will cap the gains and limit your upside potential. While you keep the premium and receive the strike price, which is a profit, you forego further appreciation from the stock. So the impact is you participate in limited upside but underperform the stock along in big rallies. The bottom line: covered calls are the most effective in flat to mildly bullish markets where they generate steady income and reduce volatility. In bear markets, they offer partial protection, and in bull markets, they may underperform due to capped gains. Understanding market context helps traders align covered call strategies with their expectations and risk tolerance. Now, as you can see, this really just reinforces what we discussed earlier when we went through the different profit and loss diagrams. Okay, the way that I have chosen to evaluate the market environment is explained in detail here on this slide. I used weekly prices from 1993 to 2024, so 31 years, on the S&P 500, and I analyzed to establish decision rules based off of market conditions. I looked at simple, weighted, and exponential moving averages to identify reliable market signals. I used the 50, 100, and 200-day simple moving averages, which seem to yield the best results. Now, there are 6 combinations for these 3 moving average. The most optimistic scenario occurs when the 50-day is highest and the 200-day is lowest, indicating a gradually increasing market. Conversely, the most pessimistic scenario happens when the 200-day is highest and the 50-day is the lowest. This suggests a continuously decreasing market. Based on the analysis of these 31 years modeled, the next 2 favorite scenarios are termed green, while the remaining 2 are classified as yellow. Using these criteria, cumulative returns are 332% for green, 22% for yellow, and negative 52% for red. Now, these are cumulative. I've added them up, right? So there's no compounding going into this at all. The weekly average for green and yellow is similar, though the standard deviation is 60% higher for yellow. So it is appropriate to kind of back off a bit when you get into a yellow market. The returns are about the same, but volatility does increase significant enough that I think backing off is warranted. The red results indicate those returns are negative, and the standard deviation is significantly higher, over twice that of the green scenario. Delving deeper, performance is analyzed by year. There is a slight decrease in positive years, while this is offset during the 8 down years. This suggests that there is a small sacrifice during favorable periods to mitigate losses significantly during unfavorable periods. In the last column, I have listed the recommended investment level. Now, as we talked about earlier, I'm never recommending that we're 100% invested. And I think I explained this in a pretty good amount of detail prior. So in green, we were looking at a 75% investment level. And then when we fall into the yellow category, I recommend we drop down to about 50%. And then in the red level, I think going all the way down to 0 is appropriate. But we were red in April and May earlier this year, and I found that some ETFs, like Bitcoin, and I actually bought the volatility index, did very well with that. But anyway, getting your investments down to about 0 to 25% is what I recommend. Now, I do want to stress that you're going to get whiplash using this every so often. This would have done great in 2008 and 2009. If any of you are as old as I am, you do remember those days and remember what a horrible market those were. This strategy would have had you out of a good chunk of that. But I will tell you that this year, when we did get that kind of whiplash bottom down in April and May, we would have gone to a 0% investment level for a week or two, only to see the market really climb back up relatively quickly. So, again, I think this is a good strategy to kind of keep yourself in the game. But do keep in mind that you will see whiplashes happen from time to time and wish that you just stayed in the game. Okay, following up on this market environment, every week in the newsletter, I do have a chart similar to the one here. This is for the most recent newsletter for the week ending July the 25th. As you can see here, I'm using... Now, these are weekly charts, so I can get more information on there. Now, earlier I said that I'm using a 50, 100, and 200-day simple moving average. To be a little more specific or more accurate, this is actually a 49-day, a 98-day, and a 196-day, because it is working in 7-day increments. So this is the most positive type of chart that you can see. I mentioned this earlier. A green market, the most green market, the most bullish market, is when the 50-day is on top and the 200-day is on bottom. Okay, to summarize this video, this whole video was about risk optimization. And we started off going through 6 risk rules. The first being to limit exposure to 75% of investment capital. Second is to max capital allocation per trade is between 5 and 10% of the portfolio. We're going to leverage weekly options to spread out exposure. We're going to diversify across sectors and limit exposure to any sector to less than 20% of trades. We are going to diversify across implied volatility by choosing stocks with different IVs, and we're going to do the same for stock price by choosing trades with different stock prices. For strategy variations, we are going to leverage the covered call naked put is kind of the most aggressive strategy, and the one that I trade in my personal account. We can add a purchase put below the sold put to turn that into a put credit spread. We can not have any puts at all, which just makes it a covered call, or we could just trade the stock only with no options at all. And of course, you can also add a protective put to any one of the 4 strategies to make the total number of variations 8. And finally, we ended up going through the market environment and discussed a methodology that I have developed, which classifies the market as either red, yellow, or green. And we are going to have only 75% invested during green, and we're going to back off during yellow and back off even further, even as much as to 0 during red market environments. I currently offer 2 actually very different newsletters. One is the Bull Strangle newsletter, which is a stock and option newsletter. And then I also offer a Spread Edge newsletter, which is about commodity futures. The Bull Strangle newsletter is the basis of this presentation. This newsletter offers rock solid stock picks, and I'm very excited to describe exactly how I come up with those stock picks, and I think you'll be very impressed with the results that we've been getting. It also entails various variations to suit most risk tolerances. So there is kind of the full strategy that I trade in my personal account, but then I offer other variations for people who want to take a little bit less risk. I've got documented track record that is beating the S&P 500 by over 240%. And there are a wide variety of effective risk optimization rules that I have developed and teach in this video and in the newsletter. And then there's the Spread Edge Commodity Futures newsletter. This is, again, commodity futures on a broad range of commodity markets, largely energy, grains, meats, softs, and a little bit of metals. And they are spread trades, which involves the simultaneous buying and selling of the same commodity with different expiration dates. I've got over 15 years of experience trading seasonal spreads, and the newsletter allows you to trade alongside an experienced commodity trader. So I lay out exactly what I intend to do, and you are able to either do exactly that or do some variation of it, basically at your will. And of course, that's the same for both strategies. And again, it requires a minimal investment to get started because commodity futures actually have a tremendous amount of leverage. One thing that is the common across both strategies and both newsletters is that they do not require much maintenance for effective management. With the Bull Strangle, for example, all trades are placed on Monday and for expiration 4 Fridays later. And then with the commodity futures, it's similar. There may be trades across the week, but there's just a few trades each day, and they are swing trades so that they have a defined entry and defined exit date. So managing both strategies is actually quite simple.